Today we're diving into something super important, especially for all of you across Europe who are looking to get your money working for you. Hello and welcome. Today we'll explore 5 smart investment strategies tailored for beginners in Europe. Whether you're just starting or planning to grow your portfolio, these tips will guide you toward financial success. I know investing can sound intimidating, especially when you're just starting out. You hear all these terms, see all these charts, and it feels like you need a PhD in finance just to understand it. But trust me, it doesn't have to be that complicated. The goal here isn't to get you to time the market perfectly or find that one unicorn stock that's going to make you a millionaire overnight, because let's be real, that's mostly luck and not a sustainable strategy. Instead, we're focusing on building a solid foundation, understanding the core principles that can lead to long-term financial growth, specifically within the European context. We'll cover things that are practical, actionable, and designed to help you build wealth steadily and safely. We're talking about strategies that have stood the test of time and are accessible to pretty much anyone willing to put in a little bit of effort to learn. So, if you've been thinking about investing but felt overwhelmed, or maybe you've dabbled a bit but aren't sure if you're on the right track, this video is for you. We're going to break down 5 key strategies that can really make a difference, especially when you're navigating the European investment landscape. Make sure you stick around until the end, because each of these points builds on the last, and understanding the whole picture is crucial. And hey, if you get any value out of this, you know what to do. Smash that like button for the YouTube algorithm. It really helps the channel out. Let's get into it. All right, kicking things off with strategy number 1, and this is a big one, folks. Diversify your portfolio. You've probably heard the old saying, don't put all your eggs in one basket, and when it comes to investing, that couldn't be more true. Imagine you put all your hard-earned cash into one single company's stock. If that company does incredibly well, great, you're golden. But what if it tanks? What if there's a scandal, or a new competitor comes along, or the industry just takes a nosedive? Well, then your entire investment could be in serious trouble. That's a level of risk that, frankly, most of us, especially beginners, should not be taking. Diversification is your first line of defense against that kind of catastrophic loss. It's about spreading your money out. So how do you actually do this, especially in Europe? It means investing across different types of assets. We're talking about a mix of stocks, which give you a piece of ownership in companies, bonds, which are essentially loans you make to governments or corporations in return for interest payments, and potentially other things like real estate or commodities. Though for beginners, stocks and bonds are the primary focus. Within stocks, you can diversify further by investing in companies across different industries: technology, healthcare, consumer goods, energy, and also different countries within Europe and even globally. The European market itself is diverse, with strong economies like Germany and France, and emerging opportunities elsewhere. Spreading your investments helps cushion the blow if one particular area underperforms. The beauty of diversification is that it aims to reduce your overall risk without necessarily sacrificing all your potential returns. While one investment might be down, another might be up, smoothing out the ride. Think of it like a well-balanced meal. You need different food groups for optimal health, and your portfolio needs different asset classes for optimal financial health. For European beginners, this could mean looking at pan-European stock ETFs, or funds that invest in a mix of European government bonds. The key is not to get too concentrated. We want to build a robust portfolio that can weather different economic storms, and diversification is fundamental to achieving that. It's the bedrock of sensible investing. Okay, moving on to strategy number 2, and this one is a personal favorite of mine, especially for anyone just starting their investment journey in Europe. Start with low-cost index funds. Now, if index funds sounds like complex financial jargon, don't worry, it's actually incredibly simple and powerful. An index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to replicate the performance of a specific market index, like the FTSE 100 in the UK, the DX40 in Germany, the CAC 40 in France, or a broader European index like the Euro Stoxx 50 or the MSCI Europe. Instead of trying to pick individual winning stocks, which is incredibly difficult even for professionals, you're essentially buying a small piece of all the companies in that index. The biggest advantage here, and why I recommend them so strongly, is their low cost. Actively managed funds, where a fund manager is trying to beat the market, come with higher fees. And guess what? Study after study shows that most active managers fail to consistently outperform their benchmark index over the long term, especially after you factor in those higher fees. Index funds, on the other hand, are passively managed. They just track the index, so their operating costs are much lower. These lower fees, often called the expense ratio, can make a huge difference to your returns over time, especially when the compound interest gets involved. Every fraction of a percent you save in fees is more money working for you. For a European beginner, this is fantastic because it gives you instant diversification, tying back to our first point, across a broad segment of the market with a single investment. You can find index funds or ETFs that track major European indices, specific country indices, or even global indices, all available through European brokers. It takes the guesswork out of stock picking and allows you to participate in the overall growth of the market. Think of it as setting your investment on a sensible autopilot. You're not trying to be a market genius, you're just harnessing the collective power of many established companies. It's a straightforward, effective, and cost-efficient way to start building wealth, and it's perfectly suited for beginners. All right, strategy number 3 is all about being smart with your money, not just in terms of what you invest in, but you invest it to keep more of your hard-earned gains. We're talking about taking advantage of tax-advantaged accounts. Now, taxes are a fact of life and investment gains can be taxable. However, many European governments offer specific types of accounts designed to encourage saving and investing by providing tax breaks. These breaks can come in various forms. Maybe your contributions are tax deductible, or your investment growth is tax-free, or withdrawals in retirement are tax-free. Whatever the specific benefit, it means more of your money stays in your pocket and continues to compound. The specific names and rules for these accounts will vary from country to country across Europe, so this is where a little bit of local research is key. For example, if you're in the UK, you've likely heard of ESAs, or individual savings accounts like the stocks and shares ISA, where your investment growth and income are sheltered from UK income tax and capital gains tax. In France, there's the PEA, or Plan d'épargne en actions, which offers tax advantages for investing in European equities. Germany has its own schemes related to Riester or Ruhrp pensions that can offer tax benefits for long-term savings. Other countries will have similar setups. The crucial thing is to find out what's available where you live and understand how it works. Ignoring these accounts is like leaving free money on the table. If you have the option to invest in a way that reduces your tax burden, you should absolutely explore it. The difference it can make to your final investment pot over decades can be substantial. Think about it, if you're saving, say, 20% or more in taxes on your gains, that's a significant boost to your overall return, achieved without taking on any additional investment risk. So your homework after watching this video is to investigate the tax-advantaged investment or savings accounts available in your specific European country. Check your government's financial advice websites, talk to a local financial advisor if you need to, but definitely don't overlook this powerful strategy. Now for our 4th strategy, and this one is all about playing the long game and harnessing one of the most powerful forces in finance. Invest consistently over time. This is often referred to as dollar cost averaging, or in our European context, you could call it euro cost averaging. The core idea is incredibly simple. Instead of trying to time the market, which, let's be honest, is nearly impossible to do consistently, you commit to investing a fixed amount of money at regular intervals, say every month or every quarter, regardless of what the market is doing. Whether the market is up, down or sideways, you just keep investing that same amount. Why is this so effective, especially for beginners? Well, for one, it takes emotion out of the equation. When markets are volatile, it's easy to get scared and sell, or get greedy and buy too much at the top. By automating your investments, you stick to your plan. Secondly, when you invest a fixed amount regularly, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this can lead to a lower average cost per share compared to if you'd invested a lump sum at potentially the wrong time. It smooths out the bumps and helps you benefit from market dips by acquiring assets more cheaply. But the real magic here, combined with consistency, is the power of compound interest or compound returns. This is where your investment earnings start generating their own earnings. It's like a snowball rolling downhill, getting bigger and bigger over time. Even small, regular investments can grow into a very significant sum over decades thanks to this compounding effect. It's not about getting rich quick, it's about disciplined, patient wealth building. So figure out an amount you can comfortably invest each month, even if it's just 50 or 100 euros to start. Set up an automatic transfer to your investment account and let consistency and compounding do their work. This disciplined approach is a hallmark of successful long-term investors. And finally, our fifth smart investment strategy for European beginners is arguably the most important one because it underpins all the others. Educate yourself continuously. The financial world isn't static. Markets change, new investment products emerge, regulations evolve, and your own financial circumstances and goals will shift over time. Committing to ongoing learning about personal finance, investing, and economic trends is crucial for making informed decisions and adapting your strategy as needed. This isn't about becoming a Wall Street guru, but about developing a solid understanding of the principles that drive wealth creation and risk management. So, where can you find reliable information? There are tons of resources out there. Start with reputable financial news websites. Many major European newspapers and financial publications have excellent sections. Look for books written by respected investors and financial planners. There are also countless high-quality podcasts, YouTube channels, like Daily Bagura, hopefully, and online courses dedicated to personal finance and investing, many of which cater specifically to a European audience or cover global principles that apply everywhere. Be critical of your sources, though. Look for information that is objective, evidence-based, and transparent about any potential biases. Avoid schemes that promise guaranteed high returns quickly. If it sounds too good to be true, it almost certainly is. The more you learn, the more confident you'll become in managing your own financial future. You'll be better equipped to understand different investment options, assess risk, and spot opportunities. You'll also be less likely to fall prey to fads or make emotionally driven investment mistakes. Think of your financial knowledge as an asset that appreciates over time. The effort you put into understanding how money works and how to make it work for you will pay dividends for the rest of your life. This commitment to learning is what separates savvy investors from those who are just guessing. It's an ongoing journey, not a destination. So embrace the process of becoming more financially literate. So, there you have it. 5 smart investment strategies specifically tailored for all you beginners out there in Europe looking to build a brighter financial future. We've covered the importance of diversification to spread your risk, the simplicity and cost-effectiveness of starting with low-cost index funds, the power of utilizing tax-advantaged accounts available across Europe, the incredible long-term benefits of investing consistently, and finally, the absolute necessity of continuous self-education in the world of finance. These aren't get-rich-quick schemes. They are foundational principles for steady, sustainable wealth creation. Remember, investing is a marathon, not a sprint. Start smart, stay patient, and watch your wealth grow. It's completely normal to feel a bit overwhelmed at first, but by taking these steps one at a time, you can build a solid investment plan that works for you and your goals within the European context. The key is to start, even if it's with a small amount, and to remain disciplined and committed to your long-term plan. Don't let fear or complexity paralyze you from taking action. The sooner you begin, the more time your money has to benefit from the power of compounding. I really hope this breakdown has given you some clarity and confidence to take those first steps on your investment journey. If you found this video helpful, please give it a massive thumbs up. It really does help the channel reach more people, and of course subscribe to Daily Bagura for more content like this. Let me know in the comments below which of these strategies you're planning to implement first, or if you have any questions. Thanks so much for watching, and I'll see you in the next video.